Mr. Buffett, Mr. Munger, if you were about to start all over again, what profession would you choose and why?
I would choose what I do because A, I have fun at it. I'm reasonably good at it. It fits me.
Warren Buffett, CEO of Berkshire Hathaway, heard a slew of questions about investing and valuations at a 1998 speech to University of Florida MBA students. That is, until a perceptive student asked what Warren Buffett would change to live a happier life if he could live life over again. The answer he gave is genuinely remarkable, and it has motivated a lot of people to become successful investors. According to the Oracle of Omaha, the best way to accomplish a happier life is to finish the game and do something you enjoy for the rest of your life, while being surrounded by people you care about. He also stated that he only collaborates with people he enjoys working with. Hello and welcome to Wall Street Winners. In today's video, we'll discuss the possibilities of what Warren Buffett would have done if he could just start his career all over again. Buffett stated that people tend to believe they have no choice but to put up with people they would rather not be around, whether it is keeping a customer they don't like or working for a boss who is a terrible human being. Nothing could be further from the truth. In fact, remaining in the company of those people could be holding you back. Buffett emphasized that one will travel in the direction of the people with whom one associates in a 2017 meeting with Bill Gates at Columbia University. As a result, it's critical to surround yourself with people who are superior to you. Everyone has heard the saying that you are the average of the 5 people with whom spend the most time, and more studies progressively drawing links between our relationships and our health. According to one Harvard study, not having close friends can be just as harmful to your health as smoking. On the other hand, if he could start over again, he would do practically the same, that is, investing in securities. Investment securities are a type of tradable financial investment, such as stocks or fixed income instruments that are bought with the purpose of holding them for a long time. Securities are typically purchased by a broker-dealer or other intermediary for resale. Marketable securities are frequently purchased by banks to hold in their portfolios. They are typically one of 2 main sources of revenue, along with loans. Many banks have investment securities on their balance sheets, which are carried at amortized book value. The primary distinction between loans and investment securities is that loans are normally obtained through direct discussion between the borrower and the lender, whereas investment securities are frequently obtained through a third-party broker or a dealer. Banks have capital constraints on investment securities. The quantity of Type 2 securities or securities issued by a state government is limited to 10% of the bank's total capital and surplus. For example, banks benefit from investment securities because they provide liquidity as well as earnings from realized capital gains when they're sold. These can often help banks achieve their pledge requirements for government deposits as they are investment grade. Investment securities can be used as collateral in this situation. However, Buffett invests in the Benjamin Graham Value Investing School. Stocks with undeservedly low prices as opposed to their intrinsic value are sought by value investors. Although there is no universally accepted method for assessing intrinsic value, it can sometimes be approximated by looking at the foundations of a company. The value investor, like bargain hunters, looks for stocks that are undervalued by the market or stocks that are valuable but aren't recognized by the majority of purchasers. Buffett elevates the value investing concept to new heights. The efficient market hypothesis (EMH) is contested by many value investors. According to this hypothesis, stocks always trade at their fair value, making it more difficult for investors to buy undervalued stocks or sell them at inflated prices. They believe the market will finally favor high-quality stocks that have been underrepresented for a long time. Buffett, on the other hand, is concerned about the stock market's supply and demand complexities. In reality, he is concerned about the stock market's activity at all. This is the implication of Buffett's famous quote from Benjamin Graham, which states that the market is a voting mechanism in the short term, but a weighing machine in the long run. He considers each firm as a whole, thus he selects stocks entirely on the basis of their whole potential. Buffett doesn't seek financial gain when he buys these stocks as a long-term investment, but rather ownership in high-quality companies that can generate earnings. He isn't concerned about whether the market will eventually recognize a company's worth when he invests in it. He is concerned about the company's ability to generate money. Also, he avoids investing in junk because he values quality over quantity. Regardless of how cheap they become, you won't find him buying struggling enterprises. According to him, instead of finding tons of good ideas, finding a few and investing in them is a wise choice. When Buffett says that it is far better to acquire a fantastic company at a fair price than a fair company at a wonderful price, it's one of the best Buffett quotes young investors can absorb. Meanwhile, he also prefers investing in small businesses and stocks. A shareholder approached Buffett and asked for advice on which small businesses they could invest in. And while he didn't name names, he did explain why this space may be so profitable. It's always been true that small capitalization companies have been undervalued. For one thing, analysts pay less attention to them. There will be fewer institutional investors interested in the company if there are fewer analyst recommendations. Another reason small companies are frequently undervalued is that pension funds are sometimes unable to invest in them due to the structure of the mandates. Many small businesses are ruled out since these institutions are only authorized to invest considerable quantities in assets with minimal volatility in order to reduce the danger of a drawdown for retirees. Finally, these companies receive fewer media exposure, which means that ordinary investors pay less attention to them. Retail interest can have a significant impact on stock prices, as we've seen in the recent months with smaller tech stocks. There are also pointers that say that Buffett would be looking around for a stock that would be very mispriced. So how exactly are these mispriced stocks identified? Well, investors seeking to maximize their profits seek out mispriced stocks, creating long opportunities for undervalued companies and short opportunities for overvalued stocks. Not everyone, especially proponents of the efficient market hypothesis, believes a stock can be mispriced. Market prices, according to efficient markets theory, reflect all accessible information about a stock, and this information is uniform. Asset bubbles, according to these observers, are caused by rapidly shifting information and expectations rather than irrational or excessively speculative activity. Many investors feel that markets are generally efficient, but that some stocks are mispriced at different times. In other situations, a bull or a bear market can drive the entire market beyond rationality, making it difficult for investors to distinguish the peaks and troughs in an economic cycle. The market may miss information about a company. Because there are fewer investors, analysts, and media outlets monitoring these issues, small-cap stocks are especially vulnerable to erroneous information. In other circumstances, market players may underestimate the magnitude of news and cause a stock's price to be momentarily distorted. Several broad techniques can be used to identify these opportunities. Both relative and intrinsic valuations are based on the financial data and the fundamentals of a company. Investors can evaluate a stock in comparison to other stocks using the relative valuation, which employs a number of comparative criteria. Investors can use intrinsic valuation methodologies to determine the value of an underlying firm without relying on other companies or market prices. Technical analysis assists investors in identifying mispriced stocks by predicting expected future price changes included by market participants' actions. Some investors believe in the theories of Benjamin Graham and David Dodd of Columbia Business School, who argue that stocks have an intrinsic value that is dependent on the market price. According to this school of thought, a stock's intrinsic value is established by fundamental financial data with little or no reliance on future performance conjecture. Value investors expect the market price to move toward intrinsic value over time. However, market forces may temporarily drive prices above or below that level. Warren Buffett is likely the most well-known contemporary value investor, having successfully applied the Graham-Dodd theories for decades. So what are your thoughts on this? What do you think about the views and suggestions that Buffett is giving out in terms of how he could start his career all over again from scratch? Let us know in the comments below. Hope you liked this video. Please subscribe to our channel and remember to hit the like button, turn on the notification bell to never miss a new video. Share the video as far as possible because the more you know, the more you grow. Goodbye.